Hey everyone! So a massive shockwave just ripped through the Indian stock market, and honestly, it sent a lot of investors scrambling. Let's dig into what just happened.
It all started with this one pretty dramatic headline. News came out of the United States that sent this huge jolt of uncertainty through the market, and that triggered a massive sell-off, pretty much across the board. It really caught a lot of people off guard.
And this number. Wow. This is what really tells the story. At its worst point, the Sensex plunged by a staggering 849 points. That is a huge figure, and it's a clear signal of just how big of a deal this was for investor confidence.
Okay, so first things first, let's unpack exactly what happened during this plunge. How deep were the losses, really? And what did it all mean for how the market had been doing lately?
Well, the damage was pretty widespread. Along with that 849-point drop in the Sensex, the Nifty 50 also took a serious hit. It fell over 1%, slipping below that key level of 24,712. It was really a synchronized fall across India's biggest indices. And to put that into perspective for you, this single day of losses was so bad it basically erased almost all the gains the market had worked to build up through the entire month of August. Just think about that. A whole month of progress just gone in a flash.
So you're probably asking, what was the catalyst for all of this? What was the trigger? Well, the chaos came from one place, the United States.
Now, before we get into the nitty-gritty, let's just quickly make sure we're all on the same page. A tariff. It's pretty simple. It's just a tax that one country puts on stuff being imported from another country. It's a major tool in trade policy, and believe me, it can have massive economic consequences. So here's the bombshell. The U.S. Homeland Security Department put out this draft notification. In it, they proposed adding new tariffs of up to 25% on certain Indian goods. Now get this, that could bring the total tariff to a whopping 50%. And the scariest part, it was set to start as early as August 27th. This sudden move just instantly sparked fears of a full-blown trade war.
So how did this threat actually affect different parts of the Indian economy? Well, the impact wasn't the same for everyone. It created this really clear divide between winners and, well, losers.
And the divide was crystal clear. The sectors that depend heavily on exporting their goods to the U.S., we're talking about industries like textiles, chemicals, shrimp, and pharma, they got hit the hardest. But on the other side, you have the FMCG sector, fast-moving consumer goods. It proved to be pretty resilient, and that's because it mostly serves India's own strong domestic market. This quote from a market analyst just sums it up perfectly. While almost every other part of the market was bleeding red, FMCG actually managed to post some modest gains. It kind of became this safe haven for investors. And it's all because its success just doesn't depend on what's happening with international trade.
Okay, so this brings us to the big question. What happens now? With so much uncertainty in the air, let's take a look at what the experts are actually saying about the market's future.
It's a fair question to ask, right? Did this just come out of the blue? Well, according to analysts, while the sharpness of the drop was definitely alarming, the possibility of new tariffs wasn't a total shock. It was a risk that had been, and I quote, largely anticipated by people who were watching the trade situation closely.
Looking ahead, it seems like the market is caught in this huge tug-of-war. On one side, you've got these really positive factors, like strong domestic consumption and solid long-term growth in areas like finance and infrastructure. But on the other side, they're battling some serious risks, like continuous selling from foreign institutions and these nagging worries about high valuations in a pretty jittery global economy.
But there is a potential silver lining here. Despite all this turmoil, some analysts, like the folks at PL Capital, are projecting the Nifty could climb as high as 27,609 over the next year. And they're pointing to key domestic sectors like consumer staples, financials, and infrastructure as the engines that could power that growth.
So what's the big takeaway for investors? Well, the experts are really advising a cautious, deliberate approach. The advice is pretty clear. Be selective. Really focus on companies with strong fundamentals that can actually weather this storm. And above all, just stay cautious in this volatile environment.
And all of this leaves us with one final and, I think, crucial question. In a world where global trade is becoming more and more unpredictable, is focusing inward on domestic strength, like we saw with India's FMCG sector, the only sustainable way forward? It's definitely something to think about. Thanks for joining me.